We often say that time in the market is more important than timing the market.
Right.
And giving your attention to short-term movements makes you vulnerable to timing the market, or you're tempted to time the market. And there are two very important mistakes or fallacies that people make in doing that. First is called a Monte Carlo fallacy or a gambler's fallacy. Typically, if you toss a coin 3 times and all 3 times it gives heads, and next you are asked, like, for the next coin, what would you bet, head or tails? Most people would try to bet tails, that because 3 outcomes were heads, the next one should be tails. What we are trying to do is put an averaging or a mean reversion on short-term outcomes, and the mean reversion only works in the long term. So over a huge number of these tosses, heads and tails are almost equal, 50-50.
Right.
But we tend to expect it to happen even in the short term, in the few tosses that we do. So that's called a gambler's fallacy. Why it got the name Monte Carlo fallacy also. In 1913, in Monte Carlo, in a casino, when people were playing roulette, and there were a lot of people who generally bet between a red number and a black number. So the wheel is divided equally between them. So there was a series of black numbers that came, so people kept betting the next one would be red. And that particular evening, the black number came 26 times in a row, and people lost millions. So it's also called as the Monte Carlo fallacy, where because the dice or the roulette doesn't remember what was the previous outcome. It's just moving on a random basis. The opposite of that is also a fallacy. When you are saying that gambler's fallacy is about expecting mean reversion within short term, there's another fallacy called the hot hand fallacy, which is about expecting a trend to continue just because there are few data points that say this trend is continuing. So hot hand fallacy comes from basketball. A lot of fans, when they see a player making a few baskets in a row, they say that player has a hot hand. He's on a streak. So we will see more baskets from that player. Now, in markets, typically some people will say that if, say, foreign investors have bought 3-4 days in a row, there is a lot of foreign money that is coming. People tend to extrapolate that okay, now the foreign investors are viewing the country very favorably, and this money will keep continuing. So expecting mean reversion is also a problem when you look at very short-term data, and expecting a trend to start just because a few data points have come is also wrong. These kinds of timing issues get people into trouble and lead them to substandard returns.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.